chat, and I will get the information to Barb so she can address those particular questions either when the topic is being discussed, or maybe we'll hold that to the end depending on the type of question. So with that, I'd love to turn it over to Barb Nuss, the founder and owner of Profit Soup.
Thanks for that introduction, Larry, and thanks to all of you for chiming in today. I want to start by saying I do not do tax returns for a living anymore. There was a time when I did. I am a CPA by trade, but I prefer to spend my time looking out the front of the boat instead of the back of the boat now. So I really focus on planning, on decision making, on doing the right thing to make a more valuable business. Taxes is a part of what we do, but I don't fill out forms. You know, taxes is a part of what we think about, but I'm not a tax preparer. And as such, I am not the expert here in exactly every single tax law. But what I would like to share with you, because I probably know more about it than the average bear, I would like to share with you some of the things that are in the new tax law that might cause us to make a decision that wouldn't necessarily be the very best decision for our business in the long run. What I mean here is, don't let the tax tail wag the business dog. Let's kind of dive into that a little bit. What do you think a good tax decision is? We all think about wanting to do what? Pay less tax. So when I say, what's a good tax decision, most of us are thinking in our mind, I want to pay less tax. That's always a good strategy, is to pay less tax. I'm not discounting that at all. But what's a good business decision? It's one that creates opportunity. It's one that builds net worth. It's one that improves our profit, maybe even improves our cash flow. And there are some tax decisions that negate those four great business decisions. And we just want to make sure that we don't chase the carrot, we don't chase the wrong thing. And I want to talk about 3.5 decisions about your business that you may want to be thinking about because potentially the good tax decision may not be a great business decision. So the 3 actual decisions that I think this new tax law causes us to want to rethink are here for you. The new tax rates, and there's a new thing that's a 20% deduction for pass-through businesses, make these really important questions. And I'm going to talk more about what's a pass-through business and what's a 20% deduction. We'll get into those details. But getting the right answer to these questions is way more complex than you think it should be. And it's not necessarily going to be the same for everybody. So instead of going through a long list of detailed changes for individuals and businesses, I'm going to focus on parts of the new laws that impact these important decisions. There have been a lot of changes for individuals that many people are talking about. The issues that get the most attention are losing some of these itemized deductions that they call it SALT, because accountants are the king of acronyms. The state and local tax deduction is what SALT stands for. We heard a lot about that. You used to be able to write off all the taxes you pay now as an itemized deduction. Now it's only the first $10,000. And so there's been a lot of talk about that, and really the impact of that is not a big deal. I mean, it's going to change things a little, but not a lot of dollars are invested in the things that people are worrying about, which is kind of human nature. We focus on the things that we can understand. And while this big ugly list of black and white here might be really interesting for tax geeks, I think if you were one of them, you would have chosen a different career. So I'm not going to dive into a whole bunch of this. I'm going to dive into the things that really impact businesses. But I will tell you, if you have a little bit of tax geek in you, you may want to Google Motley Fool 2018 tax, because they have a really great article called Your Complete Guide to 2018 Tax Changes. As with many things Motley Fool, it is really well written and really a really great thing. So most of your businesses are probably considered pass-through businesses. And a pass-through business is one that doesn't pay income tax on its own. Instead, the net profit of the business, it passes through to the owner's return. And the owner pays tax at their individual rate. So proprietors, sole proprietors, LLCs, partnerships, S corporations, those are all pass-through business. And because the income goes to the owner's personal tax return, the individual tax reports are really important to business people. And these rates are changing. Here's a comparison of the individual tax rates for married taxpayers filing jointly. We're going to look at single rates in a moment. And the 2018 individual tax rates are they're really not all that different from the 2017 rates. And at first glance, the tax percentages look a little bit lower. But what's really significant here is that the brackets are actually bigger. And when I say brackets, I mean the range of earnings that are represented by each row in that table. And while the rates aren't that different, the brackets change quite a bit, beginning at around, I'm going to get my little pen on here, beginning at around the 150,000 range. See here, it was 150 to 233, now it's 150 to 315. So now that bracket lasts longer, whereas it used to be a married couple that was earning $300,000 in taxable income. They would have been in this 33% bracket. Now they're going to be back here in this 24% bracket, and that's the marginal tax bracket. So that's quite a difference. Now, when I say marginal tax bracket of 24%, what I mean is that their last dollar, their top dollar that they earned, is taxed at 24% or 24 cents on the dollar. So they still had other earnings in the lower brackets that were taxed at lower rates. So their effective rate, say like if you total up all the tax of all the brackets and divide it by your total income, your effective rate would be less than 24%. But the marginal rate, when we say marginal rate, what we mean is the rate at which your top dollar is taxed is 24%. So while the rates aren't all that different, since the brackets are larger now, more of our income gets taxed at the lower rates. Now, if you were to look at the rates for single taxpayers, you'd see the brackets are a little bit larger, but the changes aren't as significant as they are for married taxpayers. And the net result and actually the goal of this was to eliminate what people called the marriage penalty. Because before 2018, two single people who each earned $90,000 a year, they would have been in a 25% tax bracket as a $90,000 single earner. But a married couple making the same amount of 180 would have been in a 28% tax bracket. So the income ranges have been realigned so that the brackets for the married are about double that of the single. So now two single people would pay the same tax as one married couple earning the same amount. So I think that's good, because they did this by lowering by making the lower brackets bigger for everybody. They just did that more for married people than they did for single people. There's still a bit of a marriage penalty for couples that are earning more than $400,000, but in most situations, it's going to seem a lot more equitable now. So I want those of you who are old marrieds, okay, I want you to look at this table. I want you to write down a number on any scratch paper or whatever, or if you can write it in your mind, that's okay, but don't forget it. Write down the number based on this chart of what you think your marginal tax rate will be in 2018. So guess what you think your taxable income would be, and write down a percentage between 10 and 37%. And I know you don't know for sure, just guess something that's in the range of possible for you. This is going to be important because we're going to use that number later when we're talking about the impact of some of these changes. So be sure to write down a tax percentage from a bracket that seems reasonable to you. If you're single, I've got another table for you. So if you're married, write down your number right now because this chart is going to go away. Ready? On 3, 2, 1, we have a chart going away. I think we do. Let's see. Let me advance. All right. So now let's move to the single chart. And my my little scribbling stays up there, so I'm going to erase that. Get rid of all that. So if you look at this single chart, find the rate that makes sense for you, and write down your marginal tax rate that you think you'll pay from the 2018 column in this table. Again, this is important because it's going to help you put some of the other things we're going to discuss into perspective for you. Okay, everybody's got their rates all written down and ready to go. The next thing is to think about business tax changes. All right. Again, there's a big list of stuff that we're not going to dive into a lot of the gory details, but there are two that get the most attention, and rightfully so. And that is there are huge reductions in the corporate tax rates, and there are changes in the depreciation rules. And I want to talk about the tax rates first. So these are the old tax rates. Before 2018, corporations had tax brackets that ranged from 15% to 39%. And that 39% tax bracket, it's right there in the middle. You can see it at $100,000 to $335,000, which happens to be where most small businesses fall. So if you were earning a profit of $200,000, you would have been paying a 28% tax as a pass-through company because you were paying it at the individual rates instead of 39% as a corporation. And because of those differences in tax rates, many owners chose an S corporation or an LLC, which are pass-through entities. So now this is kind of an interesting twist. Now we have a flat 21% tax rate for corporations, no brackets, all right? So here are some arrows that show you how the tax for corporations will differ for companies at various amounts of profit using the new rates instead of the old rates. So on $300,000 of profit, if you were a corporation both years, you'd pay $37,000 less in tax with the new 21% rate as compared to the old corporate rates. So not only is 21% lower than the old corporate rates, but it's lower than the number some of you wrote down as your new marginal tax rate, right? Compare that 21% to the number you wrote down. So some of you are thinking now 21% sounds better, and it's got people wondering whether they should revoke their S Corp election to become a C corporation, which you absolutely can do. But if you do, you can't go back to an S corporation for 5 years. Now, this is an opportunity for the tax tail to wag the business dog. If you're thinking about this, get some help, because there are some other reasons why a C corporation might be better for you, and of course there are some way it might be worse. So one of those reasons why it might be worse is because in a C corporation, you've heard this saying before, that the money can get taxed twice. Because if the C corporation, they pay tax on their profit, and if then they pay a dividend to their owners, which you're probably used to doing if you're an S corporation, that dividend becomes taxable then to the individual who receives it, even though we've already paid tax on the profit that we're distributing to them. So that's one of the reasons why a lot of people have become S corporations. That's why we like S corporations, because what we can do is we can pay ourselves a small salary that's subject to Social Security and Medicare tax, and then pay out more in dividends, which saves us some money on payroll taxes, right? That's what we're doing now. And some of you are going, yep, I do that. People have been doing that for a long time. And while it lowers your payroll tax, it also lowers your Social Security benefits when you retire. And if you have a retirement plan in the business, when you pay yourself less on like a W-2 paycheck, the amount that you can save for retirement is also less. So typically, I think it's a really bad strategy to reduce your wages to save Social Security tax, but a lot of people do it. This is a great example of the tax tail wagging the business dog. Okay, so we're doing that already. Okay, let's go back to the decision, what type of entity should I be? I've got some clients that are revoking their S corporation election right now because the numbers would work out well for them. This is one of those 3.5 business decisions you should rethink in relation to the new tax rules. But don't do it without help of a good advisor who can assess the nuances behind just the rate changes. Now, as you can imagine, there is a great big roar about how unfair it is for a company that's earning, $30 million to only be paying 21% tax when a small business is paying like up to 37% tax because we're a pass-through business. So, and before we get too far away from that, I want to back up and talk about the retirement thing one more piece, a little bit before we let go of that. I know a lot of you are thinking, wow, she just said that the thing I've been doing for a really long time is a bad idea, and that is pay myself a small salary. You get the short-term tax savings, but it costs you future opportunity, and that future opportunity is to fund retirement and to collect Social Security tax. It's to collect Social Security benefits. And you might say, hey, I've got time to save for retirement later. Get that out of your head. You need to start now. When you have your own business, nobody's going to do it for you. So monitor your Social Security earnings statements. They used to send you those things every year, but now you have to get online and look at them. So if you don't know how, ask Google, because Google knows everything. But you should be monitoring, am I paying Social Security tax on enough wages to get myself the maximum benefit? Because that's something we all should have been doing for a very long time and should continue to do under the new tax rules. So let's go back to this whole big uproar that we were talking about how unfair it is that businesses are paying this, that our corporations are paying this 21% as compared to pass-through businesses like what most of us are. I'm going to keep going. That pass-through businesses like most of us are paying more. Interestingly, pass-through businesses earn a majority of the business income in this country, and they employ a majority of the private sector workforce. And while that top corporate rate dropped from 35 to 21, the top individual rate dropped from 39 to 37. So it's like, hey, that doesn't seem very fair. And in response to that, they created this new provision, and it's called the QBI deduction, which is short for Qualified Business Income Deduction. And it's designed to level the playing field for business owners by taxing them on only 80% of what their business makes. And indirectly, that leads us to our next business decision, which is how much should I pay owners? Stay with me on this. You're going to understand shortly why the Qualified Business Income Deduction is going to make you rethink your owner compensation strategy. Now, as I mentioned before, I am not a tax preparer, but I am a CPA, and that means I have to take continuing education classes and get my credit. And I took a course a little while ago, and I saw this diagram which demonstrates how you calculate the Qualified Business Income Deduction. And you can see that it's pretty ugly. Now, the thing that makes this ugly, some of these gory details, don't apply to most people. I'm not going to go into all of that complication, because calculating the deduction can be simple, but it also can be complicated. So what I'm going to do is I'm going to give you the Cliff Notes version. Here's the deal. Owners of pass-through businesses deduct 20% of their business income. It comes right off your taxable income. And you don't have to do itemized deductions to get it. Okay, so it comes off right before you figure out how much tax you pay. So the intent of this is to help make it more fair that corporations got a big tax break and individuals didn't. For the most part, the complicated bits are designed to prevent abuse. They expected that service business that's really a one-man band, or even like a professional, they thought the lawyers and the accountants would say, okay, I'm not an employee anymore, I'm now a business, therefore I only have to pay tax on 80% of my income, and therefore we would make ourselves 1099 contractors instead of W-2 employees from the firms that we worked for, and that we would take advantage of this loophole, because that's what people do, is they take advantage of loopholes. So they put in these complications for high-income service businesses, and they limited those deductions for maybe some other high-income individuals if they don't employ other people. If it's just a one-person show, that's not what this is designed to help. It was designed to help the majority of businesses that were employing the majority of the workforce. And so if you weren't employing a bunch of people, you were really going to get phased out of this benefit. And that's why it got complicated. Then what they realized when they did that is that people who had a large amounts of real estate investments and a lot of real estate income were not going to be able to take advantage of it either. So then they made it even more complicated to create a loophole so those people could take advantage of this. But I'm not going to dive into all of those complications. There are a couple of rules that you need to keep in mind. One is that your wages come off the income used to compute the deduction. So if it's the amount after your W-2, so it's the bottom line of the business after you've paid yourself a payroll check. And then you take that 20%. The other thing you need to keep in mind is that the deduction is going to be reduced from that if your taxable income is less than your business income. So for example, if you've got other losses from somewhere else, if you got a bunch of Section 179 depreciation coming through that makes your taxable income go away, you can never take a deduction that's bigger than 20% of your taxable income. So this is why you should meet with your tax advisor to talk about how the new tax laws are going to change your situation and determine whether you should make adjustments to your compensation. I'm going to share with you a calculator that I found that makes it kind of simple to determine the deduction, and I'm going to walk through a couple scenarios with you so you can get the hang of what I think is weird about this and hard about this. Just a moment while I switch what I'm sharing with you. Larry, can you confirm you're seeing the deduction calculator now?
Yes, I see it.
All right, good deal. So this is kind of a cool little calculator. You can see the link up here. I just Googled QBI tax calculator, and I got this BradfordTaxInstitute.com. The slide deck is going to be available to you, and there's actually a link to it in the slide deck. So if you happen to be looking for it, you can find it this way. But I'm going to show you a couple of simple scenarios here. And let's start with, I'm going to say I'm married. I'm going to say I'm making $300,000 in taxable income. Now let's just say that that is $100,000 was a W-2 I took out of my company. $100,000 was the net profit of my company after the W-2. So I made 200, I paid myself 100. The net that passed through was 100, and the 100 came through on a W-2. And then my spouse made another 100 on another W-2. So I have $300,000 in taxable income, but my qualified business income is only the $100,000. that I paid, that was my bottom line for my business. I'm not a service business, because you guys aren't. You got, and people you employ, you've got equipment. It's not a one-man show. So there is a qualifier for wages paid by a business, but not for you, only for service businesses. So we really don't have to even care about that. So you notice down below it says use this calculation. The calculator is already showing you what the rules were that made that be you. Okay. If you had selected that you were a service business, it would have told you to use one of these other calculations. So you're going to always be in this simple calculation column, and the deduction is 20%, right? So it's $20,000. So now let's just say, think about this. How much tax does that save? Now look at the paper where you wrote down your marginal tax bracket and multiply the deduction by that rate, and that's your tax savings. So if you wrote down 24%, then the tax savings, let's see, that would be $4,800 would be what this had saved you. Okay, that's a good chunk of money. Now, let's do a different scenario. But this time, what I'm going to do is I'm going to pay myself less on my W-2. I'm going to reduce my W-2 by $50,000, which is going to increase my business income by $50,000, right? It's not going to change my net taxable income because the W-2 goes down, the business income goes up. So I'm still making $300,000, counting my spouse's $100,000, but now my business income is $50,000 higher, right? Because I didn't pay myself as much as a W-2. Now my deduction's $30,000. So you guys are going to go out there and you're going to pay yourselves less. You're going to get caught into that tax tail business dog thing again about not paying into Social Security. So we've created an incentive for people to not save for their retirement, which feels yucky to me as far as tax policy goes. So be careful about that. Check your Social Security wage statements to make sure that you're still building toward receiving the maximum benefit. The Social Security wage base is $128,400. So once you get over that, you're not paying any Social Security tax anyway. So, I could see a lot of people capping their salary at $128,400. And some of you, I'm sure you're thinking, I wish I were paying myself that much. But, take the business and financial classes that we're going to be offering, and we're going to get you so that you're over that threshold, and this will be a high-class problem for you. So we always want to make more money. We always want to pay more taxes. It means we're making more money. So don't lose sight of that part of it either. But what I'm concerned about here is we've created a tax law that causes us to be short-sighted in our thinking. And we have to be mature adults and save for ourselves because nobody else is going to. All right, so I'm going to use the same numbers here. But this time, let's say that I own the building that my business operates in, and I pay myself some rent. Okay, so if I write myself a rent check, that is going, and maybe I want to write myself an even bigger rent check than I used to. That's going to lower my business income, right, from my company, but it increases the rental income, and commercial property rental income gets the credit. So it's a wash. So it doesn't make any difference. So why did I talk about it? Ooh, wait, what if it was a C corporation? So the bottom line, I'm getting that 21% tax rate I'm paying on my income, but I also own my building. So what I might want to do is pay myself a big rent check, and that rent check that comes out to me personally qualifies for the credit. So 20% of the rent is not taxable at all. And that's why some of my clients are revoking their S elections, because they own the building. And they have another vehicle for savings, because they can avoid 20% tax on 20% of what they pay themselves for the rent. Profits from commercial real estate count. Now, they're subject to some of the tricky rules, but they don't tend to cause a disadvantage for a real estate mogul. Wonder why that is. The net result of all of this is that 20% of the net profits from commercial real estate are no longer taxable in the US. And so many people want to become those real estate moguls that are not going to get taxed on everything they earn. So when I said there's 3.5 things to rethink because of the new law, the half is how much rent should you pay yourself? I called it a half because I expect that at least half of you don't own your own building. It's always been a good strategy to buy the building and have your business make the payments, but it's an even better strategy now. Granted, not everybody has that opportunity, but you gotta always be looking at the next best opportunity, and this is gotta be in your radar screen. So I'm going to click back to our other presentation now. And Larry, can you confirm, are we back?
Yes, confirmed.
Okay, way to go. The technology isn't always as fun as it should be. So the 20% deduction is going to help make it more fair that corporations got a big tax break and that the pass-through businesses didn't get it. It's also going to give big breaks to owners of commercial real estate. So let's talk a little about depreciation, because that's gotten a lot of attention. And it's the last business decision I'm going to ask you to rethink today, which is, should I buy more equipment? There's a lot of speak out there about depreciation and how, because of the tax law change, you should go buy some stuff. I want to put that into perspective a little bit. Depreciation, all it really is allocating the cost of an asset that you buy, say, call it equipment, over its useful life so that you can better assess its economic contribution to your profit. So what's that mean? If you spend $200,000 in equipment, you take one business resource, and that's cash, and you invest it in another business resource, and that's equipment. So the day you spent the 200 grand, you had less cash, but you had some equipment that had value. Unlike the cash, the value of the equipment is going to go down over time, but you're going to make money from using the equipment. It's going to produce revenue. It's going to do the jobs. Depreciation takes that $200,000 investment and it spreads it over the time that the equipment's beneficial to you. We call that its useful life. And the reason that's a great concept is because it matches the expense over the revenue that this thing creates, so you can actually figure out if you're making any economic profit from this thing. It's really useful because it helps us accurately measure our profit. Now, when most of us think of depreciation, we don't think about this. Instead, we think about taxes. Our goal is to pay as little tax as possible. And the new tax law allows us to write off up to $1 million of what we spend on equipment each year. So if you're thinking, great, that's a gift. The tax laws don't give you any extra deductions. They just let you take it all at once instead of over the economic useful life. So the good news is you pay less tax in the first year, but you're going to pay more later. That doesn't necessarily mean it's a bad idea to take the deduction as soon as you can. But let me just kind of show you what I mean here. Let's say you bought a piece of equipment that costs $200,000 and it should be useful for 5 years. Here we're using a straight line method, assuming the value goes away equally each year. So after 5 years, you've expensed the entire purchase price, right? Now let's look at the tax impact. or how the tax depreciation is a little bit different. In the first year, we can write off the whole thing. So in the tax savings in the first year is roughly, you can see the difference. Year one profit, it would have been $260 if we'd written it off $40,000 a year. Instead, we're going to write it off all at once. So the difference is $160,000 in taxable income. If you're in a 24% bracket, that saves you $38,000 in tax, which might just about cover the first year of payments on the equipment. So that's kind of a nice thing. But for the next 4 years, you're going to actually be paying more tax because you're not going to have any depreciation left to deduct. So in year one, you're really more profitable than your tax return says you are. And in year 5, you're really less profitable than your tax return says you are, which is why depreciation on your financial statements can be so misleading. It's still a good idea to take the deduction as soon as you can because there's a time value of money, especially if you take the tax you saved and deployed it in the business in ways that creates more opportunity. The problem is that in years 2 to 5, you're probably still making payments on the equipment loans and you don't get any deductions for that because you already wrote off the cost of the equipment. You're only going to get deductions for the interest portion. So in year 1, you're going to have less profit but more cash because all that tax savings. And years 2 through 5, you're going to have more profit but no cash. And you're going to say, hey, how come if I made that much money, I don't have any cash? And that's one of the things that contributes to cash flow problems is we weren't thinking about, wow, I should have deployed that tax savings in ways that was going to help me later. So I do recommend using economic reality, the table on the left, for your financial statements so you can really understand if you're making profitable decisions. You can do that and still take the tax deduction on your tax return. It's called a book-to-tax difference. Your accountant can handle it. It takes them a little bit of extra time to account for things that way, but it makes your financial statements more useful for you because you're actually matching the expense against the income and not getting this tax tail wagging your business dog so that you can't even see how much money you're making. So some people are going to buy equipment at the end of the year to make the profit go away and not have to pay the tax. But then they're going to have debt to repay in the future. Now, if you need the equipment, by all means, buy it in December instead of January and February so you can get the benefit on this year's tax bill instead of having to wait a year. But don't let tax savings be the reason why you buy it. Buy it because your old stuff isn't cutting it or because you need more stuff as a part of your growth strategy. So don't let the tax law be what makes you decide. It's okay to let it help you decide when, but not what to buy. So there have been a lot of other changes about depreciation besides that Section 179 amount, that's $1 million. The rest of them don't amount to a whole bunch of stuff, so I'm not going to dive into the details. I guess luxury automobiles, they lightened up on, so it might make more sense to buy yourself a nice car than it used to. But sometimes it's just better not to accelerate the deductions. It's complicated. Get some help and contact your tax advisor on this. There's so much stuff that we didn't even talk about, and talk about boring. If you're the tax geek, go ahead and dive in. But these are the top items that really impact those big 3.5 decisions that I thought that you should be aware of. Of course, accountant can never say anything without a disclaimer. The IRS has not issued guidance on how some of this tricky stuff is going to apply, but they will. And that is a bit of a worry because we could make a decision based on how we interpret things today, and the IRS could issue retroactive guidelines that conflict with our positions. And this bill is really poorly written. There's a bunch of things that weren't defined well, and they're going to define them later. And we think we know how they're going to define them, but we're not quite sure. So you really got to be ahead of the curve on this one and be using somebody to help you with these decisions that really know what the latest word is on it today. Don't forget that I'm not your tax advisor, neither is Speed Pro Imaging, neither is Larry. And you should really visit your accountant about how all these things impact your taxes, how they impact your choice of entity, your compensation strategies, and your depreciation and equipment investment plans. So at that, thanks for hanging through all that boring stuff. Anybody have any questions? Larry, did we get any questions come through?
Just about, would the PowerPoint be available? And you had already said it would be. Of course, everyone, we've recorded this webinar as well. So I'll start with a question. Just a couple of slides ago, Barb, you talked about the leasehold improvement may not have to be depreciated over 15 years. Can you give just a little guidance on that? Because everybody, when they started, has TIs that they have to take care of, or leasehold improvements. And
yeah, it doesn't, sure, it's not retroactive to the ones that you bought before. I think that provision might be retroactive to September 2017. Go talk to somebody on that. But it used to be those things were 15-year property, and back before that, those things were like 39-year property. So now those are even subject to Section 179. So you might be able to write them all off in 1 year.
Okay.
This is one of the areas where it's poorly written, but we believe that's what it's going to mean. They have to be used in the trader business. It appears that it's going to work out well because they really are being favorable to real estate type things. So yeah, it appears that those things you're going to be able to Section 179 those in the future. And maybe, don't quote me on this, but I think that one might be retroactive to September of 2017.
Okay, fair enough. The other thing is, well, we still have everybody on. We have your class that you're going to be teaching on financial management under Speed Pro will be on July 31st. Can you give a plug to everybody why they should consider attending? And everyone, the class is free. All you have to do is travel here. You may want to consider being here for the 2 days of sales training, which is on August 1st and 2nd, and even maybe the leadership and recruiting retention, which is on August 3rd. But Barb, let's give a plug for why somebody should be attending that class of yours.
Sure. Mine is on, I think, July 31st. So it'd be that ahead of those things, that other things that Larry mentioned. So we're, because it's really cool. It's really fun. And what's more fun than making more money and figuring out how to plan your way to more profit and more growth and a better, more valuable business? Okay, so we take the whole premise of what we're looking at is you got into your business for one reason, and that was to get out of it better than you got in. So we're going to look at what are the drivers of business value? How much do I want this business to be worth? By when? And how do I create this growth plan? I mean, what do I have to achieve each year based on my cost structure? What do I have to achieve each year to meet my personal financial goals of why I even bought this business? So that's really big picture. And we're going to start there. But then we're going to dive down into, hey, how does your financial information help you assess whether you're on track with that plan to produce that level of value? And obviously you can get there faster if you're more efficient at how you drive profit out of your sales and how efficient you drive sales out of all your resources. We're going to talk about how do you measure how well you're doing, because that's part of a continuous improvement process. Measurement is the catalyst for change. If we know what targets we should be working toward and by when, then we can monitor against them and we can set our plans in place that would allow us to get there and have like this strategy instead of just showing up for work every day and hoping it works out okay. So it's going to help us be proactive and, in what I would say, intentional about driving profit in our business and about driving cash flow in our business for one reason, and that's to drive wealth and drive value so that when you get out, you can get out good. So it's fun, it's interactive, it's a lot of dialogue with other people in the room about brainstorming about what are the things that will drive that success. So it's not just about how do you calculate numbers, because that's the only reason we calculate numbers is to keep score to see if we're doing the right things. What we're really focused on is what do you have to do in a day also to make the numbers come out the way you want. So it's really fun, it's engaging. You'll walk away with some new routines that will keep you focused on the things that matter. And that's the things that build your value.
Awesome. That really was a good promotion and commercial. Thank you.
On the fly too. You didn't tell me I was going to need to do that, but I got to say, I just really believe in this stuff, and it's easy to sell things that you really believe in.
Absolutely. Any questions out there? Anybody else? Otherwise, we can end the webinar. Let me just give another 30 seconds here and see. For those of you contemplating maybe a question, don't forget next week, for those of you who went to convention, you'll have a repeat of Patrick Kelly. He'll be doing a webinar same time next week, but he's going to take his presentation to the next level with some exercises for you to work on to improve the culture and your recruiting and retention ability within your studio. And so there's the plug for that. Let's see here. Just great stuff. Thank you, David. Appreciate that. It was a very good webinar. As you could tell, very complicated stuff. And Barbara's directing you to talk to your tax advisor and take what she's presented and maybe go to your tax preparer and tax advisor and see what's in the best interest of your business. So Barb, thank you very much. As always, thank you for taking the time to do this webinar. We're really excited about doing more work with you as we move forward in the future, and to everybody's success. Thank you very much. Take care.
All right, I look forward to meeting all of you guys in the future. Bye for now.
Bye-bye, Barb. Thank you. Bye, everyone.